Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Tuesday, September 21st, 2021. Happy first day of autumn. And it's, relatively happier day out there, certainly happier feeling for most investors than it was yesterday, with markets trying to bounce a bit. Now, as we're taping this, it's about 20 after 10 Eastern time. We're definitely seeing U.S. Markets off their highs. Now, let's put things in perspective a bit. First of all, as we wrote in our note yesterday, which I urge you to read because I'll be referencing it throughout this video, we broke through the 50-day average, moving average on S&P fairly convincingly yesterday. I believe that triggered stops and other sorts of selling, and we went more or less right down to the 100-day moving average, which was something we addressed in the piece yesterday as being the next logical support. We flirted with that. We actually broke through it slightly on the downside, but then at about 3:30 in the afternoon, Eastern time, a half hour before the close, U.S. markets basically shot up like a rocket. So to put it in perspective, right now we're seeing about a 10-point gain on SPX, but we got about a 40-point gain in SPX between 3:30 and 4 o'clock. So it was clear that the buying the dip that one would have expected to happen after a successful test, or at least for the time being a successful test of the 100-day moving average, we saw it yesterday. And so I think what we saw overnight was an overreaction. We saw 1% over 1% higher at various points on the futures. We saw us open about a 0.5% higher, try to rally a bit, and we've since kind of eased off. This is what you should expect to see. We shouldn't really be expecting to see these big, sharp bounces up, down, sideways, blah, blah, blah. What we have now is a bit of a normal back and fill. Now, remember also, when you see these bounces off of the lows, there's an old saying which hasn't really come into play very often because we haven't seen it very much, but bear market rallies are short, sharp, and furious. So a lot of times, especially in an environment where you've had people conditioned to buy the dip, you're going to see a bounce back that looks really ferocious and can risk you getting sucked in a little bit. That's why I think you had to have the perspective that we saw a big rally yesterday. We saw us come off about 1% off our lows between the in the last half hour of the day. That is probably your tradable dip right there. And I think chasing anything further, simply for the sake of chasing it, becomes a little misleading. Now, the problem becomes if we start to tick lower today, you'll see all the headlines and all the commentary. See, it's 2 down days in a row. But it's going to be it would have to be down about another % for us to start to test the levels that we saw yesterday. What this means is that we still see the 50-day moving average pointing higher. That seems to be broken as a really solid support level, and one that had lasted pretty much since November without really much of a hiccup. And we're now probably going to be using the 100-day moving average as the newer support line. Both moving averages are pointing higher. Technically, that means we're still in an uptrend. When you're in an uptrend, it tends to behoove you to buy dips and sell rallies. The problem is that doesn't necessarily hold at turning points. And I think it's a little early to say that we're fully at a turning point yet. We have seen that 5% correction that people have been talking about that we hadn't seen in months. Let me also mention here that nobody ever talked about a 5% correction. It was fairly normal for markets to move up and down 5% at any given point, or to give back 5% from gains. It's only in this environment that we've been in since last March, when the Fed has been pumping in liquidity at unprecedented rates, and with fiscal stimulus coming at unprecedented rates, that we haven't even seen the pullbacks that are at all meaningful. That really, they talk about is the Fed backstopping the market or whatever. Enormous money flows and unsolicited and checks flowing into people's accounts. That does backstop the market. That provides a lift. It also, I think, has gotten people into the behavior that every dip, no matter how minor, needs to be bought. What I've led off this video is talking about when and where to consider buying the dip off of yesterday's rally. At this point, the 100-day moving average potentially being that point, and it was yesterday. But That doesn't mean that every dip should be mechanically bought just because we're lower. That doesn't always work that way. And I think a lot of investors have learned the hard way that may not be the case. Another thing investors, I think, learned the hard way yesterday was I think many had thought that cryptocurrencies were a safe haven asset. I will tell you definitively, I never understood that. And I think I wrote a piece a few months ago comparing digital gold to actual physical gold. And there's a huge difference. People are buying cryptocurrencies on huge leverage. For starters, Bitcoin has an average daily volatility of about 4% a day. There are various crypto platforms out there that will offer you 20 times leverage or more. Well, you don't have to be a real mathematician to realize that if you're buying something with 20 times leverage, a 5% move wipes you out. And if you average 4% moves on a day, a 5% move is something that's going to come with reasonable frequency. And so as a result, you really can't consider a safe haven asset something that has that much leverage attached to it. The part of the safety idea of gold is it's sitting in people's vaults someplace. It's sitting in a bank vault. It's sitting in people's basement. I don't know what people do with it, but they're typically not buying and selling it on the type of margin that people are doing with cryptocurrencies. Until or unless that changes, I really dismiss the argument that cryptos offer a safe haven. They've slightly decorrelated, but the history at various points during this market rally, but the history just isn't there. Gold, we have thousands of years of history, and by no means am I this huge gold bug. I'm just trying to put things in perspective. Gold has been considered a safe haven asset for thousands of years. Sometimes it doesn't particularly work very well. And quite honestly, if you live in a country where you can issue your own currency, gold is less of a safe haven than if you live in a country that tends to borrow in another currency because it protects you against the devaluations if they occur. And so cryptos I guess have the feature of owning an asset that's transferable into another currency or denominated in U.S. dollars in many cases. But as long as the cryptocurrency business allows the kind of leverage that it does, it can't be a safe haven. You can't have a safe haven asset when that many people are using borrowed money to invest in it. And that's really, those are the lessons that I would take away. This is a big week. I would stay nimble. You have the UN General Assembly. Literally, as I'm taping this video right now, President Biden is speaking. So you're going to have all kinds of speeches and posturing from world leaders. There's a Fed meeting. It commenced now. The press conference is tomorrow afternoon. It will be very interesting to see how the markets take the commentary from Chairman Powell, particularly in the press conference, particularly regarding tapering. Will they announce a date where tapering may start? Remember what tapering is, by the way. Keep this in mind. It's the Fed right now is buying about $120 billion a month in bonds. Tapering means that they will slow that purchasing amount down on a monthly or quarterly basis. The details remain to be announced. I think there's reasonable consensus that tapering will start. The question is how soon and how fast, which is a big difference than what we've seen through most of the market rally where monetary accommodation was taken as a given. Now it's a question of not going to be, I don't even know what the opposite of unaccommodative. It's not even a matter of not being accommodative, but it's certainly removing some of the extraordinary accommodation that we've seen. Consider it, I've used this terminology before, consider it as someone taking his foot off the accelerator. We've been driving the car at or above the posted speed limit, and now we're taking our foot off the accelerator. What does that mean? We're not tapping on the brake. The Fed is not doing that yet. But I think a lot will have to be gleaned from the chairman's comments tomorrow. So it's a busy week. We got off to a volatile start. As of now, we're giving back some of the early gains that we saw in U.S. trading. Remember that really those gains occurred yesterday in the last half hour of trading, well before this morning. And I didn't even mention Evergrande in any big way. There's so much commentary out there. Let me just suffice to say, I don't see it as Lehman Brothers. I think I wrote about that yesterday as well. I've taken up too much of your time as it is. Thanks for your patience. And have a great autumn, everybody. Bye-bye.